Imagine a financial institution so deeply embedded in the American mythos that its very logo, a horse-drawn stagecoach, was synonymous with pioneer trust. This was Wells Fargo, a bank that survived the 2008 subprime mortgage crisis largely unscathed, only to hollow itself out from the inside. This was not a sophisticated Wall Street derivatives scheme orchestrated by rogue traders in penthouse suites. It was a billion-dollar deception carried out by minimum-wage tellers and branch managers armed with nothing more than keyboards and desperate mandates. Millions of innocent people had their identities weaponized, their credit profiles quietly hijacked to feed an insatiable corporate machine. The stagecoach was secretly running down its own passengers. The architecture of this massive betrayal was built on a seemingly benign retail banking strategy known as cross-selling, the practice of aggressively marketing additional financial products to an existing customer base. If a client had a checking account, the logic dictated they also needed a savings account, a credit card, a mortgage, and a line of credit. Under the leadership of Chief Executive Officer John Stumpf, this standard industry practice was mutated into an absolute, unyielding corporate religion. John Stumpf championed a slogan that would become the blueprint for systemic ruin, famously telling investors that the bank's goal was 8 products per customer, an internal mantra dubbed "going for great." Wall Street rewarded this aggressive posturing with soaring stock valuations. Investors marveled at the bank's unparalleled ability to generate revenue from its existing consumer base without the expensive overhead of acquiring new clients. On paper, the metrics were flawless, projecting an image of a highly engaged, deeply loyal customer demographic. The institution became the most valuable bank in the world by market capitalization. Yet, the pristine financial statements filed with the Securities and Exchange Commission masked a fundamentally toxic corporate culture that was rapidly deteriorating at the granular level. Down in the fluorescent-lit trenches of neighborhood branches, the reality of this strategy was a daily psychological grinder. The institution imposed draconian sales quotas on its lowest-paid employees, demanding impossible conversion rates that defied the natural limits of consumer demand. Tellers and personal bankers were subjected to relentless morning huddles where managers would publicly humiliate those failing to meet their daily product targets. The pressure was not merely aspirational, it was an existential threat to their livelihoods, with employees explicitly told to meet the numbers or face immediate termination. Faced with the impossible choice between losing their jobs and breaking the law, a staggering number of employees chose survival. They began fabricating reality to satisfy the algorithmic demands of the corporate hierarchy. This gave birth to a dark lexicon of internal fraud. Employees engaged in pinning, a tactic where bankers assigned unauthorized personal identification numbers to client debit cards, allowing them to activate the cards without the customer's knowledge. They practiced sandbagging, delaying the opening of legitimately requested accounts until the next reporting period to ensure future quotas were met. The methods grew increasingly brazen as the pressure compounded. Bankers forged signatures, created fictitious email addresses, and temporarily transferred funds from legitimate client accounts to fund the initial deposits of unauthorized accounts. This money movement was a highly coordinated shell game, executed entirely within the bank's internal network. When the newly created accounts inevitably incurred maintenance fees due to insufficient balances, those charges were quietly debited against the customer's real, hard-earned money. The collateral damage of this relentless numerical pursuit was profound and highly personal. Customers began noticing inexplicable overdraft fees and receiving collection calls for credit cards they had never applied for. The creation of unauthorized credit accounts triggered hard inquiries on consumer credit reports, subtly damaging the financial reputations of millions of Americans. A lowered credit score could mean the difference between securing a mortgage or being denied, paying a reasonable interest rate on an auto loan, or being subjected to predatory terms. The bank was effectively stripping wealth and financial security from the very people it promised to protect. The tragedy was compounded by the swift and brutal suppression of internal dissent. Employees who recognized the criminality of these actions and attempted to blow the whistle were systematically silenced. The bank maintained a confidential ethics hotline, ostensibly designed to protect integrity and report malfeasance. In practice, it functioned as a surveillance trap. Human resources and regional managers routinely weaponize the internal reporting system to identify dissenters, subsequently terminating them under the guise of minor infractions like tardiness or fabricated performance issues. This ruthless retaliation created a chilling effect that insulated the executive suite from accountability. Regional managers, whose own lucrative bonuses were tied to the aggregate sales figures of their districts, actively encouraged the blind pursuit of numbers. They instituted a policy of willful ignorance, turning a blind eye to obvious red flags, such as branches reporting product adoption rates that mathematically exceeded the adult populations of their respective zip codes. The fraud was not a bug in the system. It was the system itself, operating exactly as the incentive structure dictated. The fortress of deception finally began to fracture, not from internal audits or federal regulators, but from local investigative journalism. In 2013, the Los Angeles Times published a blistering expose detailing the relentless pressure cooker environment and the rampant creation of unauthorized accounts in Southern California branches. The reporting pierced the carefully cultivated public relations narrative, exposing a stark dichotomy between the bank's wholesome marketing campaigns and the predatory reality of its retail operations. The journalistic revelations forced a sluggish regulatory apparatus into motion. The Los Angeles City Attorney launched an investigation, eventually joined by the Office of the Comptroller of the Currency and the Consumer Financial Protection Bureau, commonly referred to as the CFPB. Investigators began subpoenaing internal communications, employment records, and customer complaints. As forensic accountants and federal lawyers peeled back the layers of the retail banking division, the sheer scale of the localized fraud metastasized into a national scandal. By September 2016, the findings were made public and the numbers defied comprehension. Regulators revealed that bank employees had secretly opened more than 2 million unauthorized deposit and credit card accounts over a 5-year period. This figure would later be revised upward to a staggering 3.5 million fake accounts. The institution agreed to pay $185 million in initial fines, a historic penalty for the CFPB at the time, but a mere fraction of the profits generated during the era of unchecked cross-selling. The public disclosure ignited a firestorm of outrage, shifting the spotlight directly onto the executive leadership. John Stumpf attempted to contain the damage by framing the massive systemic failure as the isolated actions of rogue, low-level employees. The bank announced the termination of 5,300 retail workers, scapegoating the tellers and personal bankers who had been suffocated by the very quotas the executive suite had championed. This strategic deflection proved to be a catastrophic miscalculation, enraging the public and lawmakers alike. The crisis culminated in a highly publicized, brutal series of hearings before the United States Senate Banking Committee. Lawmakers from across the political spectrum dismantled the bank's defense, interrogating the chief executive with searing precision. They highlighted the gross hypocrisy of an executive who earned tens of millions of dollars in performance bonuses tied to fraudulent metrics, while minimum wage workers were fired for either failing to meet impossible quotas or for reporting the fraud. The hearing stripped away the corporate veneer, exposing a profound vacuum of ethical leadership. The intense political and public pressure rendered the executive defense untenable. Within weeks of the disastrous congressional testimony, John Stumpf abruptly resigned, forfeiting $41 million in unvested equity awards. He was followed by the head of the community banking division, who was stripped of her lucrative exit package. Yet the departure of the architects did not immediately cure the institutional rot. The regulatory investigations had fundamentally altered the trajectory of the company, triggering a cascade of subsequent probes into other divisions of the bank. The fake accounts scandal acted as a master key, unlocking a vault of widespread corporate malfeasance across the institution. Subsequent investigations revealed that the bank had also charged hundreds of thousands of borrowers for unnecessary auto insurance, pushing some into wrongful vehicle repossession. They had inappropriately charged mortgage applicants for delays in processing that were the bank's own fault. The toxic culture of prioritizing revenue over consumer protection had infected nearly every consumer-facing product line. In response to this unprecedented pattern of consumer abuse, the Federal Reserve took an extraordinary and historic step in 2018. They imposed a massive asset cap on the bank, strictly prohibiting the institution from growing its total assets beyond its end of 2017 level until it could definitively prove it had overhauled its governance and risk management controls. This regulatory chokehold was the ultimate financial sanction, effectively freezing the bank's ability to compete and expand in a booming economic landscape. The shockwaves of this prolonged saga forced a reckoning across the entire financial services industry. Competitors quietly scrambled to audit their own internal sales practices, suddenly terrified of the very incentive structures they had spent decades perfecting. The scandal became the definitive modern case study in how misaligned compensation metrics can weaponize a workforce. It shattered the illusion that retail banking was a sleepy, low-risk sector, proving that granular consumer fraud, when scaled across thousands of branches, poses a systemic threat. Today, the legacy of this massive deception serves as a grim monument to the dangers of unchecked corporate ambition. It is a stark reminder that when a company demands the impossible from its employees, it inevitably manufactures a culture of deceit. The millions of phantom accounts were not merely data points on a regulatory settlement. They were the direct result of an institution that forgot its fundamental duty to the public, choosing instead to sacrifice its integrity, its employees, and its customers on the altar of relentless, unsustainable growth.